In today's video, I'm going to show you 6 smart ways to save money on taxes and 1 bonus way. The fact is most of us give more money to Uncle Sam than we legally have to. Now, I'm not talking about tax evasion or shady offshore accounts. I'm talking about strategies written directly into the tax code that the wealthy use every single day, while the rest of us, we just don't. Last year alone, American taxpayers overpaid by an estimated $1.5 billion simply because they didn't know these strategies existed. Today, I'm breaking down these 6 powerful and completely legal ways to significantly reduce your tax burden, plus that 1 bonus strategy that flips the entire game in your favor. But here's the catch. One of these strategies has a deadline that most people miss, and it costs them thousands. So stick around because I'll reveal exactly which strategy has a ticking clock, and it might be sooner than you think. In this episode, you'll learn 3 wealth decision principles to remember that will make you smarter with money, plus an action plan to help you make better wealth decisions starting today. So let me tell you about Robert. He's in sales. He makes about $280,000 a year. And when he first came to me, he was paying over $70,000 in federal income taxes alone. He kind of felt stuck. And he said, Brian, I work incredibly hard and I watch almost 1/3 of my income disappear every year to taxes. We're all in the same boat. The more you make, the more you pay in taxes. Now, here's what frustrated Robert the most. He knew wealthy people, even some of his friends, weren't paying anywhere near that percentage. He read the headlines and he knew there had to be a legal way to keep more of what he earned. And he was right. The difference between Robert and those wealthy individuals wasn't income. It was information. The tax code is over 70,000 pages long. It buried in those pages legal strategies designed to incentivize certain behaviors. The problem is that most people never learn about them. Your typical tax preparer, they're playing defense, just filling out forms based upon what you've already done. But what if you could play offense instead? That's exactly what we're doing today. I'm going to show you how to restructure your financial life so that the IRS becomes a smaller player in your wealth building journey, and you become a bigger beneficiary of your hard work and success. This is Brian, the author of the book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life, and the founder of Momentous Wealth Advisors. I've been a financial advisor for over 25 years, and I've helped hundreds of families reduce their tax bill by using these exact strategies. This isn't theory. This is what actually works. So the first way to save money on taxes is using tax-free and tax advantage investment. This is the foundation. Here's a question for you. Have you ever felt like you're being taxed twice on the saved dollar? Well, because in most cases, you are. Think about it. You earn money, that's taxed. You invest that money, sell the investments, taxed again. Then you pass it to your kids, potentially taxed again. But certain investment vehicles are specifically designed to break that cycle. Roth IRAs are the most powerful wealth building tool most people underutilize. And here's why. You pay taxes on the money going in, but then this is the great part. All growth and all withdrawals in retirement are completely tax-free. Now, let me put this into perspective. If you contribute $7,000 a year to a Roth IRA from age 30 to 65, assuming an 8% annual return, you'd have roughly $1.2 million at retirement. And the IRS, they'd get 0 of that growth, not 1 penny of that $900,000 plus in gains. This leads me to wealth decision principle number 1. The best tax rate is 0. Design your portfolio to get there. Think about it this way. Would you rather pay tax on the seed or the harvest? With a Roth IRA, you're paying tax on the seed. That's $7,000 contribution. But the harvest, that massive tree of wealth you've grown, that's all yours. But here's where most people kind of get tripped up. They think, I make too much money for a Roth IRA because there's income limits. But there's something called a backdoor Roth IRA that gets around those income limits entirely. You contribute to a non-deductible traditional IRA, which has no income limits, and then immediately convert it to a Roth. It's completely legal and really effective. Roth IRAs aren't the only game in town. Roth IRAs are just an account you put money in and invest it however you want to. But one of the investments that a lot of people don't know about is municipal bonds. They're issued by states and they offer tax-free interest at the federal level, and they're tax-free in the state that they're issued. You can get 4.5% on tax-free bonds, which doesn't sound much better than a money market today. But if you're in the 32% tax bracket, that's the equivalent of a 6.6% yield on a CD or a bond. And then there's 529 plans for education expenses. This lets your investments grow tax-free for your kids' future. And one of the really cool things about a 529 plan is they can be moved up and down within a family or sideways. So if you have 2 kids, you can move it between those children. If one of them gets a scholarship and the other one needs it for college, you can move the 529 plan from one child to another. Let's say both of them get scholarships, which would be awesome. You could actually use their 529 plans. You could move that money to a 529 plan in your name and go back to college and get your master's degree. So we just covered 3 of the tax advantage or tax-free accounts. The key question you need to ask yourself is, am I maximizing my tax-free buckets before I put another dollar in pre-tax or taxable account? Coming up next, I'm going to show you a real estate strategy that gives you tax deductions on paper while putting cash in your pocket. So stay with me because this one's a game changer for building long-term wealth. Quick reminder, if you're getting any value from this episode, like it, make a comment, and hit the subscribe button right now. By the end of this video, you'll have a step-by-step action plan that will save you thousands in taxes this year and set you up to build tax-efficient wealth for decades to come. So strategy number 2 to save more money on taxes is to buy real estate rentals. I think real estate is one of the most misunderstood wealth building strategies out there. Here's what makes real estate so powerful from a tax perspective. They call it depreciation. Now, I know that sounds boring. We know that when we buy a car, it depreciates. But we don't get to write off the depreciation of a car unless it meets the IRS standards for a business expense. But stay with me because this is where the magic happens with real estate. The IRS allows you to deduct the wear and tear on your rental property over 27.5 years, even though, here's the kicker, your property is probably increasing in value the entire time. Now, let me give you a real example. Let's say you buy a $400,000 rental property. The IRS lets you to depreciate the building portion. Let's say that's $300,000 over 27.5 years. That's roughly $11,000 in paper losses you can deduct every single year, even though you're collecting rent checks and building equity. So you might have a positive cash flow of $15,000 a year from rent, but on paper, with all of your other expenses, you're showing a loss. And that loss can offset your other income, especially if you qualify as a real estate professional or through some short-term rental loophole. Now, remember Robert, the guy in sales I mentioned earlier? He eventually purchased 2 rental properties. Between depreciation, mortgage interest deductions, and property tax deductions, he reduced his taxable income by $42,000 in the first year alone. That saved him over $14,000 in taxes, real money that stayed in his pocket. So that leads me to wealth decision principle number 2. Make money twice, once from income and twice from tax savings. Real estate lets you generate cash flow from rent while simultaneously creating paper losses that reduce your tax bill. You're literally making money in 2 directions at once. But here's the part most people miss. You need to be strategic about how you structure your real estate investments. Are you buying properties in your own name or through an LLC? Are you considering cost segregation studies to accelerate depreciation? These details matter immensely. So make sure you check with a real estate professional or a tax professional to make sure that you set up your LLC properly. And one more thing, have you ever thought about house hacking? I've talked about this in past episodes. That's when you live in one unit of a multifamily property and rent out the others. You get the tax benefits of a rental property while having your tenants help you pay your mortgage. It's one of the fastest ways to build wealth, especially when you're first starting out in your 20s or 30s. Usually when you get into your 40s or 50s and you've started to build a family, most people don't want someone living in their house. But this is a great way to reduce your costs so you can save more for the future. Now, one of my biggest regrets is not investing in real estate earlier in my life. Not just buying a house, but real estate properties. I have multiple friends that have built up an enormous amount of wealth using real estate. And I always used to just say, I don't want to deal with the headaches of owning real estate or having tenants or being a landlord. But let me ask you this. What's your biggest concern about investing in real estate? Is it the upfront cost or finding good properties or managing tenants? Drop your answer in the comments. I read every one, and one of them just might inspire a future episode. Up next, I'm revealing a savings account that gives you a triple tax advantage, and almost nobody uses it correctly. This could be worth tens of thousands of dollars over your lifetime. So the third way to beat the IRS and save money on your taxes is health savings account. Let's talk about what I call the secret retirement account. Most people think an HSA is just for medical expenses, and sure, that's one use, but here's what the wealthy understand that most people don't. An HSA is actually the most tax-advantaged retirement account in existence. Let me explain why. An HSA gives you three tax benefits. Tax deductions going in, just like a traditional 401k, you deduct your HSA contributions from your taxable income. Number two is tax-free growth. The money grows inside the account with zero taxes on investment gain. And number three, tax-free withdrawals. As long as you use the money for qualified medical expenses, you never pay tax on it coming out either. Now you compare that to a Roth IRA, which gives you two of those three benefits. An HSA is literally the only account with a triple tax advantage. And here's the strategy most people miss. Instead of using your HSA to pay current medical expenses, most people forget to invest their HSA. They keep it in cash and they think they're going to use it for some type of healthcare cost. The fact is, you can reimburse yourself years later for an expense that you pay out of pocket today. And the really cool thing about HSAs is after age 65, your HSA basically turns into a traditional IRA anyway. You can withdraw for any reason and just pay regular income tax, no penalty. But if you use it for medical expenses in retirement, and let's be honest, you're going to have some, those withdrawals remain completely tax-free. Let me give you some numbers. If you max out your HSA at $4,300 per year for an individual from age 30 to age 65, assuming an 8% return, you'd have approximately $850,000, all of which could be withdrawn tax-free for medical expenses. So this leads me to wealth decision principle number 3. Tax-free in, tax-free out, tax-free growth. That's the trifecta. When you find an investment vehicle that gives you tax advantages at all three stages, contribution, growth, and withdrawal, you max it out, period. But here's the catch. You can only contribute to an HSA if you have a high deductible health plan. For 2025, that means a deductible of at least $1,650 for individuals or $3,300 for families. So this strategy isn't for everyone, but if you qualify, it's absolutely one of the best moves you can make. Now, here's a question for you. Are you currently maximizing your HSA contribution, or are you leaving tax-free money on the table? Leave a comment with your answer. Next up, I'm going to show you a strategy that's perfect for retirees. Almost nobody knows about it, and it could save you tens of thousands while helping your favorite charity. So strategy number 4 is qualified charitable distribution. Here's a strategy specifically designed for anyone 70 and a half or older who has money in traditional IRAs. It's called the Qualified Charitable Distribution, or QCD. Now, if you're younger than that, don't tune out just yet. Share this with your parents or your grandparents because this could save them serious money. Here's the problem QCD solved. Once you hit age 73, the IRS forces you to start required minimum distributions from your traditional IRAs and 401ks. That age will eventually go up to 75, but these RMDs are fully taxable as ordinary income, which can push you into a higher tax bracket and even cause your Social Security benefits to be taxed or IRMA surcharges on your Medicare. But with a QCD, you can send up to $105,000 per year directly from your IRA to a qualified charity. And that distribution counts towards your RMD, but never shows up as taxable income. So let me break down why this is so powerful with a real example. So you're 75 years old with $600,000 in an IRA and your RMD is $25,000. If you take that $25,000 as a regular distribution, you pay ordinary income tax on all of it. Let's say $5,500 in taxes at a 22% tax bracket. But if you're charitably inclined anyway and normally donate $10,000 to your church or favorite causes, here's the better move. Instead of taking the $25,000 distribution and then separately donating $10,000, you do a $10,000 QCD directly from your IRA to the charity. Now you've reduced your taxable RMD to $15,000, saving you about $2,200 in taxes. Plus, you supported some causes you care about. I think that's kind of the definition of a win-win. And here's the bonus. QCDs can even help you avoid Medicare premium surcharges that kick in at higher income levels. By keeping your taxable income lower, you might save hundreds more on Medicare Part B and Part D premium. The catch? The money must go directly from your IRA to the charity. You can't take the distribution first and then donate it. And it has to be a qualified 501c3 organization. No donor-advised funds, no private foundations for this particular strategy. This is especially valuable if you don't itemize deductions anymore. With the higher standard deduction these days, many retirees can't even deduct their charitable contributions anyway. But with a QCD, you get the tax benefit regardless. Coming up, I'm going to reveal a strategy that turns your investment losses into wins. And it's something you should do before December 31st. This is what I talked about earlier that has a deadline. So strategy number 5 is tax loss harvesting. Now, what does tax loss harvesting mean? Well, first of all, have you ever felt frustrated watching one of your investments drop in value? Well, here's how you make that loss work for you. Tax loss harvesting is the strategy of intentionally selling investments at a loss to offset capital gains and reduce your taxable income. And here's how it works. Let's say you have 2 investments in your taxable brokerage account. Investment A gained $10,000 this year. Investment B lost $7,000. If you sell both, you owe capital gains tax on the net gain of $3,000 instead of the full $10,000. But here's where it gets even better. If your losses exceed your gains, you can deduct up to $3,000 of those losses against your ordinary income each year. And any remaining losses, they carry forward indefinitely to future tax years. Let's say you have $20,000 in losses and $5,000 in gains. You offset the $5,000 in gains completely, deduct another $3,000 against your ordinary income this year, and carry forward the remaining $12,000 to use in future years. Now, there's an important rule you need to know about this. It's called the wash sale rule. If you sell an investment at a loss and buy the same or substantially identical security within 30 days before or after the sale, the IRS disallows the loss. But here's the workaround. You can immediately buy a similar but not identical investment. For example, if you sell an S&P 500 index fund at a loss, you can immediately buy back a total market index fund. You've maintained your market exposure while still capturing the tax loss. This is something you should be reviewing at least once a year in your taxable investment account, typically in November or December. I call it year-end tax planning, and it can easily save you thousands of taxes every single year. And here's the deadline I mentioned at the beginning. You must execute these trades by December 31st for them to count for the current tax year. Miss that deadline, and you've missed a year's worth of potential tax savings. You can't go back in time. The best part, this is one of those strategies that keeps on giving. Every year, you're looking at your portfolio, harvesting losses, and either offsetting gains or reducing ordinary income. It's like giving yourself a tax refund that you created. Now, next, I'm going to reveal the strategy that ties everything together. It's about matching the right investments to the right accounts. And getting this wrong can cost you hundreds of thousands of dollars over your lifetime. So the 6th strategy to save more money on taxes and beat the IRS is to buy the right investments in the right accounts. Here's a strategy that sounds simple, but most people get completely wrong. Asset location. I'm not talking about asset allocation, how much you have in stocks versus bonds. I'm talking about which specific investments you hold in each one of your specific accounts. Now, let me give you an example of how this works. You got 3 types of accounts: taxable investment account, tax-deferred accounts, like traditional IRAs and 401ks, and tax-free accounts like Roth IRAs. Different investments are taxed differently. Bonds and real estate investment trusts generate interest and dividends taxed as ordinary income. That's the highest rate. Growth stocks might not pay dividends at all, so they're only taxed when you sell and at lower long-term capital gains rates. Index funds are tax efficient because they rarely distribute gains. So here's the rule of thumb. Put your tax inefficient investments like bonds, real estate investment trusts, and actively managed funds in your tax deferred or tax free accounts where the tax hit is eliminated or delayed. Put your tax efficient investments, your growth stocks, your index funds, in your taxable investment account where you can take advantage of the lower long-term capital gains rate. Also, in your taxable investment account, think about owning companies that pay qualified dividends. Qualified dividends are taxed at a different rate than normal dividends. So let me show you the dollar impact. Imagine you have $100,000 invested. If you put that in bonds generating 5% annually in a taxable account, you're paying ordinary income tax on that $5,000 every year, potentially $1,500 in taxes annually. But if you hold those same bonds in a traditional IRA and hold index funds in your taxable account instead, you defer all that bond tax and only pay the lower capital gains rate on your index funds when you eventually sell. Over 30 years, proper asset location can add six figures to your portfolio, not from better returns, but simply from being smarter about taxes. The bottom line, don't just think about what you own, think about where you own it. Now let's talk about the bonus strategy that I think changes everything. Bonus strategy is save more than you pay in taxes. And it's going to sound almost too simple, but save and invest more than you pay in taxes. Think about it for a second. If you're in the 24% tax bracket and you're paying, let's say, $20,000 in federal income taxes, but you're only saving $10,000 a year, you're literally giving the IRS more money than you're giving your future self. I think that's backwards. The goal isn't just to reduce your tax bill, it's to build wealth. And the fastest way to build wealth is to make your savings rate exceed your tax rate. Why should the government be a bigger beneficiary to your success than you? So let's say you earn $100,000, you pay $18,000 in taxes. Instead of complaining about the tax bill, flip the script and commit to saving $20,000 of that per year. Now you're winning. You're paying yourself more than you're paying Uncle Sam. This mindset shift is everything because here's what happens. When you commit to saving more than you pay in taxes, you automatically start looking for ways to increase your income, reduce your expenses, and yes, implement all six strategies we talked about today. You start maxing out your Roth IRA, you look into rental property, you fund your HSA, you harvest tax losses, and you optimize your asset location. Suddenly, you're not just trying to shrink one number, your tax bill, you're growing another number, your wealth. And that, my friends, is how you truly beat the IRS. Not by avoiding taxes, but by making taxes irrelevant to your wealth building equation. All right, so here's your action plan. Step one, open a Roth IRA if you don't have one, or set up automatic contributions if you do. Even $100 a month adds up to seven figures over time. Step two, if you have a high deductible health plan, open an HSA account next year and commit to maxing it out. Invest it aggressively and don't touch it except for major medical expenses. Step three, review your investment accounts before December 31st. Look for losses you can harvest to offset gains or reduce taxable income. Step four, if you're over 70 and a half, talk to your financial advisor or IRA custodian about setting up a QCD for your charitable giving. And if you're not 70 and a half yet, please share this episode with your parents or grandparents. Step five, calculate your total tax paid last year and your total savings rate. Commit to making your savings rate higher than your tax rate. And step six, if you're serious about real estate, start researching markets and talk to investors who've done it successfully. Don't wait for perfect conditions. They don't exist. Now listen, knowledge without action is just entertainment. I don't do YouTube to entertain you. That's not my shtick. I've been an advisor for 25 years, and I'm here to help you make better wealth decisions. And now you know 6 powerful strategies plus 1 bonus mindset shift that can save you tens of thousands of dollars every single year. But here's the thing, the IRS doesn't care if you know these strategies. They only lose when you implement them. So here's my challenge to you. Pick 1 strategy from today's episode and take action on it this week. Just 1. And drop a comment below and tell me which strategy you're committing to and why. I'll be in the comments personally responding and helping you work through any obstacles. And if you found this information valuable today, hit the like button, subscribe, And remember, you can't control tax rates, but you can control your strategies. So go make better wealth decisions today that can help save you more in taxes over the rest of your life. This is Brian, the Wealth Decisions Guy, and I hope to see you next week.